Hello everyone, welcome to Cryptopreneur. Decentralized finance developers looking to leverage the yield-generating potential of assets that live outside the crypto-native kingdom might just find their prayers are being answered by Wall Street's biggest bank, JPMorgan. Speaking to CoinDesk at Consensus 2022 in Austin, Texas, the head of JPMorgan's Onyx Digital Assets, Tyrone Laban, described in detail the bank's institutional-grade DeFi plans, as well as highlighting how much value in terms of tokenized assets is waiting in the wings. Over time, we think tokenizing US Treasuries or money market fund shares, for example, means these could all potentially be used as collateral in DeFi pools, Laban said. The overall goal is to bring these trillions of dollars of assets into DeFi so that we can use these new mechanisms for trading, borrowing, and lending, but with the scale of institutional assets. Institutional DeFi generally means imposing Know Your Customer, or KYC, strictures on crypto's permissionless lending pools, which has started to happen in pockets of innovation, such as AAV-ARC, as well as the recently announced project involving Siam Commercial Bank and Compound Treasury. However, JPMorgan's plans of incorporating the tokenization of traditional assets point towards an altogether different level of scale. From an Onyx Digital Assets perspective, there are two complementary parts to bringing bank-grade DeFi to fruition, explained Laban. One component is JPMorgan's blockchain-based collateral settlement system that was extended last month to include tokenized versions of BlackRock's money market fund shares, a kind of mutual fund invested in cash and highly liquid short-term debt instruments. This type of application on the Onyx Digital Assets blockchain now enjoys some $350 billion of flow, Laban pointed out. The second piece of the puzzle is the recent pilot led by the Monetary Authority of Singapore and including JPMorgan, DBS Bank, and MarketNode, dubbed Project Guardian. The initiative is all about testing institutional-friendly DeFi via permissioned liquidity pools comprising tokenized bonds and deposits. These ventures into DeFi will involve public blockchains and have a permissioned structure, similar in many ways to what is being done by the likes of AAV-ARC and Fireblocks. One difference, Laban noted, is that KYCing in Project Guardian is being done by large financial institutions that are participating as opposed to DeFi platforms and crypto-native custody firms. In other words, a JPMorgan trader has to prove they have the rights and entitlements to trade on behalf of the Wall Street Bank. But a much more striking difference is the novel approach to permissioned DeFi done using digital identity building blocks such as W3C, verifiable credentials. We want to use verifiable credentials as a way of identifying and proving identity, which is different from the current AAV model, for instance, Laban said. Verifiable credentials are interesting because they can introduce the scale that you need to provide access to these pools without necessarily having to maintain a whitelist of addresses. Since verifiable credentials are not held on chain, you can have the same overhead involved with writing this kind of information to blockchain, paying for gas fees, etc. As far as which DeFi protocols JPMorgan and its counterparties might be looking at, this decision has not yet been made, Laban said, but it will be among the recognized offerings. It'll be from the bench of protocols that you'd expect, battle-tested with high TVLs, or total value locked, but we haven't yet worked out which ones yet. Loban explained that for the past 2.5 years, JPMorgan has quietly been exploring digital identity in the context of blockchain and digital assets. If we can put this identity layer in front of DeFi that enables KYC-based access, then each of those protocols should just naturally be able to support institutions without necessarily having to make too many changes to what they're doing, Loban said. Do we have to set up separate permissioned pools and make changes to the existing protocols? Or can these things work out of the box?